let's talk about Europe, because that seems to be weighing on the minds of investors. So what about for UBS Wealth Management? Have you guys priced in a default of sorts for Greece?
Yeah, certainly. We are basically looking at a possible default for Greece, and we believe that that should actually be the case because there is no way that the situation can go on without any form of default. Whether you call it a restructuring or not, it is still a default in name.
Okay, so in light of that expectation, then, what is UBS Wealth Management advising to its clients across the Asia Pacific?
Again, we are basically saying that you need to stay defensive, and right now the best defensive positions are to be found in markets with a big domestic hinterland to actually shelter the stock market. And these are basically markets like, for instance, Malaysia, Indonesia, basically the developing parts of Asia itself. We were looking at valuations this morning, and it's actually quite interesting to see that valuations are actually not expensive at all. Asia ex-Japan is actually trading at a huge discount to its 10-year historicals, and the high beta markets like Korea and Taiwan are basically trading at about 20+% discounts to its 10-year historicals. But the defensive markets like Malaysia, for example, is actually trading bang in line with its 10-year historicals, which basically means that sentiment is actually very, very poor right now. It's no longer a question of valuations, it's just very poor sentiment across the board.
Well, you know, some are saying valuations are cheap and not expensive for a reason. That's because you're expecting a default right now in Europe. Could you call this the Lehman's event of Europe? Will this have the same effect we'll see on global markets around the world?
Perhaps, but where Asia ex-Japan is concerned, we are actually in a pretty strong position here because prior to entering the sell-off recently, Asian valuations were not at its extreme, and the difference between now and the 2008 Lehman Brothers crisis is the fact that we have plenty of liquidity at this point in time. So liquidity is not an issue here. We are not looking at a crisis at the kind of extent that we had during the Lehman Brothers crisis in 2008.
Okay, so you're saying, Kelvin, that even if Greece does default, we're not expecting the declines and basically the implosion of markets that we saw back in 2008. Is that right?
Absolutely. We don't think that is going to happen. But on a short-term basis, of course, volatility will actually be a key concern. And on a very, very short-term basis, you might actually see the markets extend lower. But that, again, is not a reflection of the economic fundamentals of the Asia ex-Japan countries.
Okay, so is it time to buy it, Kelvin, or are we going to get more dips and better entry points?
I think you could, if you were looking at markets to actually get, if you look at timing itself, you can certainly do what we call dollar cost averaging right now, and I think what you can possibly do is basically average into positions or into counters that you think are actually valuable at this point in time. Companies have actually engaged on share buybacks, which is always a good indication that they think that their share prices are actually undervalued. So yes, in a sense, yeah, you can actually start buying right now, but I wouldn't be putting 100% of my portfolio into the markets at this point in time. I'll certainly be looking at averaging in whenever there is a deep sell-off in the markets.
Yeah, okay. So, Kelvin, I got to ask you to be a little bit more specific here. Where's value right now? Which sectors, companies, et cetera, are you seeing value in?
Again, we like the high dividend yielding stocks. This sell-off has actually basically meant that high dividend stocks have actually shown high yields right now. In Singapore, a lot of the high yielding stocks are basically trading at about between 5.5% to 6.5%, which when compared to the sovereign bond yields and compared to your fixed deposit rates, they are actually very, very attractive. We would actually stick with the consumer staples as well and be allocating positions there because of the fact that we think that discretionary spending might be impacted to a certain extent by the poor sentiment that's actually spreading around right now.